A seasoned equity offering, or SEO, occurs when an already publicly traded company issues new shares to raise capital. For decades, the dominant theory in corporate finance has been that managers trigger these offerings primarily because their stock is overvalued. Firms that issue stock consistently display three traits. They have high market-to-book ratios, meaning the market values their equity far above the value of their actual net assets. They experience massive share price surges right before the offering, and they typically underperform the broader market in the years that follow. Prominent academic literature uses these exact traits to conclude that market timing is the catalyst for selling stock. The logic suggests that managers see an artificially high price and sell shares to capitalize on the mispricing. But this conclusion relies on a statistical blind spot, selection bias. By looking only at the fraction of firms that actually issued stock, the analysis ignores the behavior of the massive base of companies that chose not to act. To test whether market timing actually drives corporate behavior, researchers Harry D'Angelo, Linda D'Angelo, and Renee Stulls built a dataset that tracks the issuance decisions of all industrial firms, regardless of whether they sold stock. Examining only the survivors of a financial event creates a distorted picture. To understand why a company issues equity, you have to measure them against the baseline population that stayed on the sidelines. The literature provides a clear quantitative profile for a company holding an optimal market timing hand: a standardized market-to-book ratio of 3.0, a recent excess stock return of positive 75%, and a future excess return of negative 75%. This represents 100 identical firms facing this exact highly favorable financing window. If market timing drives issuance, we'd expect a significant portion to sell stock. But logic regression data shows that under perfect conditions, the absolute probability of an SEO is only 8.0%. 92% of companies facing a statistically perfect opportunity to exploit overvalued equity leave the financing window untouched. We can compare this to a counterprofile, a firm with completely unfavorable timing opportunities. This firm has a market-to-book ratio of 0.5, a recent stock return of negative 75%, and a future return of positive 75%. For this firm, the baseline absolute probability of issuing stock is 2.9%. Shifting from terrible timing conditions to perfect timing conditions only moves the needle by about 5 percentage points. Managers leave perfect financing windows untouched 92% of the time. This suggests that market opportunism is not the primary driver of seasoned equity offerings. Market timing proxies like valuation ratios and stock returns do register as statistically significant in regression models. This significance is exactly why the timing heuristic persists. This bar chart shows relative growth between two data points, moving from 2.9% probability under terrible conditions to 8% under perfect conditions represents a massive 176% jump. But because equity offerings are rare, this relative shift translates to a minuscule absolute change in behavior. There is a distinction between a core narrative driver that forces an action and a conditional optimizer that influences how that action is executed. Market timing is a secondary consideration. Managers will optimize the timing of an equity offering if market conditions permit, but the stock's valuation itself is rarely the reason they decide to sell. The competing framework is the corporate lifecycle theory. In this model, capital issuance is dictated by a firm's development stage rather than its current stock price. The mechanics follow corporate growth. Young firms issue equity for expansion, exceeding internal cash flow. Mature firms fund operations internally and distribute excess cash as dividends. To measure this life cycle stage in the regression models, researchers use a simple empirical proxy, the precise number of years a firm has been listed. This graph plots SEO probability against years listed. A 1-year-old firm with terrible timing conditions has a 6.5% offering probability. A 20-year-old firm with perfect timing has a lower probability, just 3.8%. The young firm is empirically 71% more likely to issue stock. The structural reality of a firm's development stage strictly dictates its behavior, overriding equity mispricing as a reliable predictor of secondary offerings. The final academic defense of the market timing theory is the cash stockpiling argument. This suggests firms issue overvalued stock simply to stockpile cash for future undefined investments. We can test this defense directly using a pro forma liquidity test. By mathematically stripping away the proceeds of the equity offering, we can observe the hypothetical survival of the firm based solely on its remaining balance sheet. This chart shows the median issuing firm's cash-to-assets ratio across 3 timelines. Pre-SEO, it's 7.2%. It spikes to 13.3% during the SEO, settling at 8.8% post-SEO. The highlighted block represents cash raised. Subtracting those proceeds yields a catastrophic result. The ratio plummets to negative 4.2%. Looking at the broader sample, if we remove the SEO proceeds, 62.6% of all issuing firms would have completely run out of cash by the very next year. Furthermore, 81.1% of the entire sample would have been forced to operate with severely subnormal cash balances. Even if we assume these firms aggressively increase their capital expenditures after raising money, the math still fails. If they had frozen their capital expenditures at pre-SEO levels, over 40% of the samples still would have hit zero cash. Stockpiling cash for future use happens in only 10% of cases. For the overwhelming majority, seasoned equity offerings are executed to prevent immediate, severe corporate illiquidity. Raising public equity involves immense friction. Companies willingly endure massive underwriting fees and the negative signaling costs of diluting existing shareholders to execute an SEO. Corporate managers do not subject their firms to this friction casually. The primary catalyst is absolute necessity, driven by it and an early corporate lifecycle stage. Market timing serves as an ancillary optimization. Firms needing cash prefer to issue at high valuations, explaining stock run-ups, but not as the root cause. Even the anomaly of older, dividend-paying firms issuing stock supports this hierarchy. Mature firms conducting SEOs typically show pre-offering Altman Z-scores, a metric used to predict the probability of bankruptcy, that indicates severe financial distress. Whether a firm is young and rapidly expanding, or old and financially distressed, the unifying driver of an equity offering is an immediate, existential lack of internally generated cash. The persistence of the market timing theory illustrates the danger of survivorship bias when evaluating corporate finance events. Analyzing only the traits of the actors who successfully take a specific action creates a distorted view of how the broader baseline population actually functions. The seasoned equity offering is a survival mechanism for capital-starved firms, triggered by the immediate constraints of the balance sheet. Raising public equity is a transaction born of necessity, rather than a tactical attempt to time the market. Raising capital is ultimately driven by the absolute reality of the corporate balance sheet.